Hello and welcome to the 2026 second quarter outlook from Capital Stewards. The war in Iran has increased uncertainty and it's left many investors with questions, even though we had a ceasefire seemingly come into force last night. So in this episode, we're going to talk about the impact that the war sort of had on the economy and may continue to have going forward. We'll talk about the impact of the ceasefire and what that means for markets and what that means if it doesn't hold over the next few weeks. Outside of the Iran situation, investors are asking about AI and its impact on companies. Is it time to ditch the Mag 7 and grow stocks for the rest of the market? And then we'll talk about the labor market. Is it simply adjusting to a new environment or is the jobs market cracking? So these are just a few of the questions that I'm hearing from investors as we head into the second quarter. So in this episode, like I do on these outlooks, I'll share my views on how we should invest during these kinds of uncertain events. We'll talk about what changes we should and should not be making as long-term investors. And then as always, these outlook episodes are a little bit longer, so you'll want to listen. I know you'll want to listen to the whole thing, but if you're looking for something specific, you can check the notes and skip ahead to specific topics. There's also a ton of charts in this episode, so if you're listening to the podcast version, that's great. Glad to have you here. You might want to consider watching on YouTube so that you can see all the charts. So, all right, let's dive in. So let's start with what's happened so far this year. On the chart, you can see the S&P 500 stock index in the red line. The index was flat for most of the first quarter leading up to the war. Concerns over AI's impact on technology and investors shifting from sort of growth stocks like the Mag 7 into other areas of the market caused the index to flatline. Then the war began in February, and you can see the market declined more than 9% before kind of rallying back to just down about 3.5% for the year. And we may see it come back to flat with the gains today. International markets, both developed and emerging markets, performed better than the S&P 500, better than the U.S. sort of large cap stock universe to start the year, and they held on to that outperformance even as the war broke out. Bonds in the purple line are now flat for the year as rates rose after the beginning of the war. And like last year, gold begins the year as the best performing asset, up 8% in the quarter, which may be confusing because if you read the news, all you hear about is how gold is going down, but it started the year really, really strong. And so it has gone down during the war, but still for the quarter clocks in as the top performing asset. Looking at long-term returns helps us stay focused on what matters during these times of uncertainty. So when we look back over 30 years, we have the tech bust. We have the great financial crisis. We have COVID. We have this war in Iran. Through all of that, the S&P 500 has returned almost 10% every year on average. Have averaged just over 4%. Inflation still only averaging 2.5% over the long term. And gold has returned just over 9% each year. So when we zoom in and look just at the last decade, the last 10 years, despite COVID, despite the sell-off that a lot of us experienced in 2022 and rising inflation over this period of time, we still see strong assets. The S&P 500 stocks are averaging 14% each year, followed closely by gold after its recent run-up. Bonds have returned 1.7% and inflation has averaged 3.2%, so a tick higher. So when we think about the 30-year and the 10-year history, you'd be a very happy investor today if you had invested at the peak of markets before the global financial crisis or right before COVID. So I think this is instructive for how we should think about investing in some of these geopolitical environments. Over the long term, the market's going to move past most of these situations. The economy will grow as companies innovate and returns will come. Investing with a well-constructed plan and sticking to that plan is the most likely way to be successful as an investor. That doesn't mean that we just blindly throw money into the stock market or any other asset. Properly building a portfolio can help you reduce risk, earn the returns you need to accomplish your goals, and reduce volatility, those kind of up and down moves that you experience during these kinds of drawdowns. So I'll talk more about the kinds of changes we should be making and not making in portfolios as we go through, but you should feel confident in your investment plan in both up and down markets. If you have concerns, then you probably should talk to whoever you work with, your professional, or if you've got concerns about that, then you should seek out new professional advice. So let's talk about where I see the market going as we move more into the second quarter. I know you want to talk about the impact of the Iran war. I'll get there in a minute, even with the sort of the ceasefire news today, but I want to make sure that we understand how the economy was performing before the conflict started in order to understand what potential outcomes might be now that we're seemingly, hopefully, on the backside of the conflict. You can see in the first chart, real GDP, which is the broadest measure of economic growth, was growing 2% towards the end of last year. We've seen that deteriorate a little bit. The Atlanta Fed GDP Now tracker is currently showing sort of a 1.6% number for the first quarter. That's in line with the overall sluggishness that I kind of talked about in the outlook for the year. Our slow growing economy has some issues kind of hiding under the covers. Some forecasters are talking about how the economy bottomed in Q3 of last year, and now it's in the midst of a turnaround. I'm not so sure that that's happening quite yet. It's possible, but I don't know that we have enough evidence to be able to say that that's true for sure. So let's talk about what businesses are doing, and then we'll talk about the consumer picture a little bit. The recent rise in sort of the ISM manufacturing index, that's now up to 52.7, and the services index at 54. You can see in the chart here, that's been hailed by some forecasters as sort of a soft landing victory. The problem is that the internal components of those surveys tell a different story. And just as a reminder, ISM is a survey. They send it out to businesses and they say, hey, are you ordering more things? Are you employing more people? Are you restocking your inventories? What kinds of activities are you taking now that we might see in your earnings down the road in the next quarter or two? So the growth that we saw in those figures was primarily driven by supplier deliveries and inventory rebuilding rather than sort of new orders and organic demand. That means that companies are delivering on old orders and they're restocking, but sort of new orders looking forward are actually quite weak. In late 2025, durable goods shipments rose materially, but that was the same backlog drain as we saw in the ISM surveys. Companies are finally delivering aircraft and defense equipment. We're probably going to see some more of that given what's happened in the Middle East. But new orders for those big durable goods, things that companies buy one time every few years that are expensive, they're stagnating or they're falling especially if we look sort of outside the defense industry, and they're actually negative. So the only real source of business growth remains the AI related CapEx. Estimates are for positive business spending this year, but all that growth comes from the AI hyperscalers still. All the other CapEx is projected to be negative, and that's not great for the economy. When we look at consumers, we see a similar week, but kind of hanging in their story, right? It's not all bad, but it's not all great either. You can see in the chart, retail sales are growing around 3%, but so of course is inflation. So what that means is that consumers are buying the same amount of stuff, they're just paying higher prices for it. The K-shaped economy that's been talked about so much over the last few years is becoming even more prevalent. That means the top income earners and asset holders are continuing to thrive, while the remainder of the population is kind of hanging in there, struggling to get by as you get towards the bottom end of the income ladder. Personal income is growing at a meager 1.75% when we adjust for inflation. That's below pre-COVID and certainly below recent levels. To make up for that lack of income growth, consumers are spending assets and they're drawing down on their savings. The personal savings rate's about 4% now. That's between a third and a half less than the typical pre-COVID 6 to 8% range. So before COVID, people were saving 6 to 8%. Now they're only saving 4%. Bank of America's internal data shows that higher income wage growth is around 4% versus lower income wage growth of only about 1.4%. That's close to the largest gap in roughly a decade. The Federal Reserve Bank of Minneapolis just published a survey this quarter on some of these divergences that we're seeing in the economy. They highlighted work from Moody's Analytics that shows spending by the top 10% of households grew at 62% between Q3 2022 and Q3 2025. That far exceeded any other income group. Over the most recent 12 months, spending by top earners grew 4% in nominal terms, while the growth for all the other groups was roughly 3%, right? Bank of America card data shows an even starker picture. Spending by the lower third of cardholders actually shrank in mid-2025, and it remains nearly flat into early 2026. So on the job market front, the story here remains the same. You can see in the chart here on the left-hand side, that green line dipped below zero in the middle of 2025. That means negative job creation, as I kind of suspected in the third quarter of last year. Wiley the Coyote, we kind of talked about him being out over the edge of the cliff and he didn't realize it yet. Job creation on a rolling 3-month average basis was negative in the middle of last year. Now we do see some recovery back to flatlining, but that's also far. On the right, you'll see my indicator for whether we're producing enough jobs. That's kind of hovering around the black line. That recent spike that you see in the last jobs report that came out actually last Friday, you can see the blue line at the left-hand chart. You see that falling a lot recently. And so we're producing enough jobs, but we're not producing more jobs. Just a lot of folks have sort of left the labor force. They've quit looking for work, and that's not really a great sign either. So overall, kind of my assessment is that job job creation, it's kind of right at zero every month. That means we could get negative results fairly quickly if anything were to happen. A continuation of what's going on in the Middle East unexpectedly or anything else could kind of knock us into pretty negative job growth territory. So, I would also point that while last month's payrolls were positive, wage growth continues to fall. So if the labor market was really getting a lot tighter, we would see workers starting to demand more pay, and they're not doing that. So the labor market is still pretty loose. So it continues to be the wealth effect. Recent gains in stocks and other assets, plus access to credit, government transfer payments, that's holding consumer spending together. The economy, from my perspective, really desperately needs inflation to go down and for real incomes to move higher. That all sounds fairly dour. We're not in a recession. And we're going to talk about contingencies in a minute around the crisis in the Middle East. But I don't expect to see a recession this year. We're in the soft part of the soft landing. If the momentum continues, then we're headed for this sort of new normal of sorts with very high productivity, strong wealth effects in the economy, high corporate margins. I think we'll know the truth on that really in the next quarter, because we're either going to see this stuff continue or we're going to see that it was really sort of a data mirage here at the end of last year and the economy is still pretty weak. We'll find out pretty soon. So now that you understand where the economy stood kind of going into the war, we can talk about the war and potential sort of outcomes here. So on February 28th, the U.S. began attacking Iran's military capabilities through missile strikes. That eventually led to Iranian attacks on the U.S. and partner countries across the Middle East. So the war generally was limited to, Iranian military targets, not major oil production assets. There was some damage to gas facilities and some oil assets in the region, but that was pretty minimal. The real challenge in the Middle East, as you probably have heard in the news, is the Strait of Hormuz and Iran's missile capabilities. Where in a world where one is too many, right? Shooting one ship and sinking it is too much for insurers to insure, and so that effectively rendered the Strait of Hormuz closed, as shipping insurers would not underwrite passages that include the strait at a reasonable cost. The world produces about $100 million barrels of oil each day. We have some of the March data now, and it looks like the total Middle East crude exports were down about 8 million barrels per day in March. And then we know there's been a loss of another 5 million barrel equivalents per day of what we call refined products. So think jet fuel, gasoline, et cetera. So that means 12 to 15 million barrels per day of oil that's not on the market. And that's what's been driving prices higher. So in oil, by the way, and its derivatives, they're not the only economic concern. So there's a lot of commodities that come out of that space: fertilizer, aluminum, gases, all exported through the Strait of Hormuz. So now with the ceasefire deal, I expect oil prices to fall back into the $80 range. We discussed this before. The world has plenty of oil. The price before the conflict was in the mid-60s. I think it's going to remain elevated here for some time. Markets will price a sort of a risk premium for potential future conflicts, for this conflict to continue reigniting. But I think the trend will be lower. We kind of say all that with the caveat because we haven't actually seen oil start moving through the Strait. So even though this deal was announced, what I'm really watching for is oil to actually start moving through the Strait of Hormuz. We have not seen that yet. But that's as of 9 o'clock in the morning here on April the 8th. So that might change in an hour, but that's where we are as of this morning. If the deal does not hold, oil prices are going to spike back up, and they're going to spike back up by a lot. The market was expecting some sort of deal to occur. That's what happened last night. So it never really priced in a full months-long closure of the Strait of Hormuz. So I would expect if there's future hostilities, you were going to see prices north of $125 a barrel pretty quickly. So let's hope that we can avoid that, because like I said, the economy, we're not in a bad place, but we're sort of skating on thin ice, and it would be great if we didn't have an oil shock to help knock us off of recovering. On the inflation front, you can see in the next chart, inflation has come down from the post-COVID highs, but it remains, stubbornly, as some folks would say, higher than the Fed's 2% target. U.S. core PCE sits about 2.83% currently. The March headline numbers are going to be higher. They're going to be closer to 4% as a kind of oil price shock is factored in. However, most of the oil-related spike is going to fade in the next few months as oil prices go lower. Tariffs, those are currently contributing about 0.4% to core inflation. Those are going to fade in the back half of the year as well. And we've seen home prices flatline, and the housing inputs to inflation are now falling significantly. And that should drive overall inflation lower as we get into the back part of the year. The one sticky spot is going to be U.S. services inflation. That may keep inflation from moving below the 2% mark for a while. And I think if you just looked at the economy and you looked at some of the other factors, you might expect inflation to actually go below 2%. I think services inflation might keep us at that 2% mark for a little bit. U.S. services saw the most inflation before COVID. That's likely going to remain the case. But I think the pull down from housing should be enough to get overall inflation very close to 2%, given the weakness in the economy that I've already kind of talked about. So on the longer term, however, our view continues to be that inflation is going to average closer to 2.5%, in this period of time as the economy really kind of reaccelerates. So what does all of that backdrop mean for investment assets? Let's start with the stock market, since that usually composes the largest part of portfolios. In the 2026 outlook back in January, I talked about the potential risk for contracting multiples on the S&P 500. And we've certainly seen that so far this year. When we use that word multiple, what we really mean is the number that's multiplied by a company's earnings to get its total valuation or to get its stock price. Multiples are higher when we expect positive growth, when we expect those earnings to grow and get larger over time, and they're lower when there's concerns about that. You can see in the chart the multiples of many of the big tech stocks that led the growth cycle over the last few years. They declined rather significantly in the first quarter of the year. I alluded to this toward the end of last year, but the market is now focused on seeing those companies realize profitable growth from AI rather than sort of merely hoping for more gains in the future. I think that's healthy for the market long term. Many of these stocks are now trading closer to their long-term average prices based on earnings, which means real earnings growth can drive more upside from here. In the US market, because of declines in sort of those big growth stocks, smaller companies have outperformed larger companies so far this year. Value has outperformed growth. Frankly, that the one place we were probably wrong in the outlook coming into the year was that we were more optimistic that growth would remain kind of in the driver's seat, and so we had to adjust rather quickly as we started the quarter. So a broader, more diversified portfolio in general has been helpful to start the year off. One place I was not wrong was about the outperformance of international stocks. This has been a consistent theme now for several quarters, and I expect it to continue for at least this year. International markets were hit hard during the Iran crisis. They have a long way to go to simply bounce back to their prior levels. The US dollar rose as a safe haven asset during the Iran war. That hurt international assets a lot more than US assets. The dollar should depreciate as tensions in the Middle East return back to normal. That only adds international performance for the next several quarters. Let's look outside of stocks and talk about the sort of diversification assets. So gold, despite all the headlines about the drawdowns during the Iranian crisis, was the strongest performing asset in the first quarter. You heard me correctly. You probably won't catch that on CNBC as everybody's having a freak out about gold. Gold peaked up 20% before the war. In 2 months was up 20%, right? So it did suffer a pretty big drawdown. It was only up 8% at the end of the first quarter. We don't own gold in portfolios hoping that it's going to go up 20% in a quarter, right? So that 8% return, though, still bested stocks and bonds in the first quarter. Much of that selling was from investors, frankly, that needed to sell winners to cover losses in other parts of their portfolios. We also saw some selling from foreign central banks, particularly Turkey, that needed to raise cash kind of, in the event that the crisis in the Middle East widened and they needed to buy real things like guns. If they got drawn into the fight, you can't buy a lot of that stuff. With gold, you got to have cold, hard American dollars to do that. So now that the conflict has abated, I would expect those central banks that raise dollars to sort of go right back into their prior diversification program. So I continue to like owning gold in this environment as a diversifying asset, particularly if we have kind of the stagflation light kind of environment that we've been talking about over the last couple of quarters. Outside of gold, bonds and other fixed income assets have been essentially flat to start the year, maybe up a little bit after today's rate move. That's because rates have risen on fears of higher oil, frankly, and on that, kicking in an inflation cycle. That's something that I cautioned about at the beginning of the year. The best performing fixed income assets, have indeed been shorter term bonds. The 10-year US Treasury has reset higher, moving from below 4% to around 4.25% today. I don't expect the economy to continue generating high levels of inflation short term. We talked about that earlier. So as the crisis abates, I would expect longer term bonds to begin to outperform again as we move back into the back part of the year. Finally, I'll talk a little bit about high yield bonds and private credit, since it's been in the news, even in the popular news a lot lately. First, I think it's worth pointing out we don't own any private credit in client portfolios. As I mentioned kind of in our alternatives podcasts back in the fall, the time to own private credit in portfolios was when inflation and rates were much lower. That was several years ago. Now the environment, is better, frankly, just for other fixed income assets, right? But I get questions about the potential for private credit to present a problem for the economy as a whole. So kind of on that, 2 points. First, let's start here. I do think private credit funds will struggle to outperform publicly available funds going forward. In fact, it wouldn't surprise me if they underperformed risk-free treasuries for a while. It's obvious that the underwriting in a lot of the private credit space was relaxed to raise more capital in the funds, and it's likely that not all of those loans are going to turn out well, as the economy undergoes significant changes in the AI world as we go through this kind of low growth environment. However, the second point is the investors in those funds are not the big money center banks with lots of leverage that can create problems for the economy at large, like what we saw in the financial crisis with mortgages. I think many of the pension funds and endowments and some of the individuals that own those funds will end up with maybe not losses, but just very lower returns than what they were expecting. And that has some impact on their personal financial situation, spending decisions. But I think it's more of a headwind at worst for the economy. I don't think it's a calamity that's capable of bringing down the system. The last point I'll make on diversifying assets is real estate. I continue to think now is the right time to be looking for properties that make sense. Generally, I recommend clients find actual real estate to own as opposed to buying through a fund. But funds are also more attractive now than they have been over the last few years. Rates are moving lower from here. That should help maybe a tailwind into real estate funds and into individual properties. So a word of caution around real estate is always simply to make sure that you're buying at prices that reflect today's rate environment. So especially if you're looking at a fund, if it hasn't been discounted from where it was a couple of years ago by 10 or 20%, that's probably not the right fund or the right property to buy. So if you can buy new properties with fresh capital, at today's interest rates that make sense, then I think real estate could be a good opportunity to own in that diversification bucket of a portfolio. So to wrap up, the Iran conflict has added a lot of uncertainty. That continues because, like I said, even though we've had a deal that's been announced, we've yet to see significant movement through the Strait of Hormuz. And so until that happens, then there's still going to be uncertainty kind of hanging over the market. The bigger takeaway, though, is that markets and economies have a long history of working through these kinds of shocks, right? We're seeing that today. The shock is over and we see the market rally, right? And so investors do best when they stay anchored into a well-built, diversified portfolio, a well-built, diversified plan that's got a high probability of accomplishing your goals. So my base case continues to be a soft but stable U.S. economy. Inflation should ease as the oil spike fades. And market leadership, potentially will shift to continue to reward kind of broader diversification, international stocks, smaller cap stocks, those kinds of things. Continue to think gold serves as a useful hedge. And fixed income likely improves. Those bonds probably drive higher returns as growth cools off and rates move lower. So a few practical steps. Reconfirm your time horizon and your required returns so that short-term headlines don't drive long-term decisions, right? If you have a long-term timeline, then what's going on this month or next month shouldn't impact your decision-making that much, right? Continue to rebalance, right? Manage risk appropriately. And especially when we have big market gyrations, rebalancing becomes particularly important because you can be pretty different from the portfolio you think you own if you're not actively rebalancing. You want to keep your equity exposure diversified beyond the Mag 7. I talked about that a little bit, right? Large companies, small companies, more balance between value and growth, and certainly international regions of the world. And then we favor a little bit more high quality liquid fixed income than we have over the last couple of years. And use real estate assets, thoughtfully, right? Real estate where, you can get attractive properties, particularly, individual properties instead of funds. If you can get those at good prices, I think it's a good opportunity to be thinking about real estate. So hopefully all of that is helpful as you think about your own situation. If you have questions about where we see the market going or about your portfolio, I'm always happy to talk about that in person over the next few weeks. Look forward to talk to you very soon.